Every single month without fail, I invest a portion of my salary into the stock market. It doesn't matter if the headlines are screaming about tariffs or recessions or bubbles. When I get paid, I invest. That tends to be a set amount, which is currently £1,500 added to my pension and £1,000 added to my stocks and shares ISA. And before we get into what I bought, let's take a look at my portfolio and some of the more interesting earnings reports from some of the stocks I own. But also, I want to take a moment to say that this is actually going to be the final YouTube video that we post. We really do appreciate all the support, but unfortunately it's just taking too much time away from us being able to focus on the more research side of things. The good news is that if you do want to keep up with what we're doing, we still have our long-running weekly podcast. So you can check out the Stocks and Savings podcast wherever you get yours, where, to be honest, you'll probably hear more detailed breakdowns of everything we're buying every single month. And hopefully a bunch of other interesting things too from the world of finance and investing. Anyway, let's get on to my portfolio. And this month I'm certainly going out with more of a whimper than a bang, because it's been an absolutely awful month for my stocks and shares ISA. Mainly because it's been an awful week, but overall, my portfolio is down 2.6% in the last month. By comparison, the global stock market is up by 1.3%, the S&P 500 is up by 1.4%, and the Nasdaq 100 is up by 1.7%. It's never fun, but when you invest in a lot of fast-growing, volatile individual stocks like I do, months and weeks like this can happen. And they can have a pretty huge impact. A lot of this was due to some pretty negative reactions to some earnings reports, and I'll go through 4 of them shortly. But, in all the carnage, there are still some honorable mentions this month. Alphabet's shares rose over 12% following a strong earnings report. My Datadog investment rose 18%, again after strong earnings, and to be honest, it's been an impressive year for both stocks. And one of my newest and smallest positions, Lemonade, was up by over 30% this month after stellar earnings. It is a volatile stock, and probably the most speculative company in my portfolio, so sharp moves like this aren't uncommon. And I'm not going to go around doing victory laps, because in a bad month, this could easily move 30% in the opposite direction. But now, I want to talk about 4 interesting earnings reports from some of the largest holdings in my portfolio. Well, some of the largest and Duolingo. I'll start with Axon Enterprise, my largest holding, whose shares are down almost 20% this month following its results. The business continues to build a full public safety platform. This includes tasers, police body cams, police in-car systems, drones and anti-drone technology, and Axon's cloud-based evidence platform that ties it all together. Revenue grew 31% to $711 million in the quarter, beating analyst estimates, and full-year revenue guidance nudged up to $2.74 billion. Now, for a company like Axon, revenue growth is the #1 thing I'm looking for. Sure, profits matter in the long term, but I want the company to keep investing aggressively so that they can become bigger and bigger. To that end, earnings per share did miss analyst estimates quite sharply, coming in at $1.17 versus expectations of $1.54. Profitability was hit by a mixture of tariff headwinds and investments into research and development. The CFO called out a number of areas where they are investing heavily back into the business in next-gen opportunities like vehicle intelligence or Axon Body Workforce Mini for frontline workers, so like retail workers and hospital workers. And that's exactly what I want to see. Growth was pretty impressive across the board too. Software and services revenue grew 41%, future contracted bookings were up 39%, and Axon's platform solution, which encompasses a lot of its next-gen products, grew 71%. International traction improved as well in this quarter, and they announced the acquisitions of Carbine and Prepared, 2 businesses with next-gen solutions for 911 emergency calls. So how many times am I going to say next-gen in this? I know the stock was expensive, so anything small can be picked on. But if the market wants to knock this business down because of margins slipping, I will be more than happy to take advantage of a lower price when it comes to my monthly investments in December. Next up, we have Duolingo, which is only a 1.5% holding in my portfolio, but a company I feel very positively about. Sadly, the market doesn't share my positivity, knocking the stock down more than 20% after the company reported its Q3 results. That adds to the misery of this stock being on what feels like a permanent slide for the last 6 months, and it's down almost 40% in the past month alone. So what on earth happened? Well, the results for the quarter were actually pretty strong. Revenue comfortably beat analyst estimates, growing 41% to reach $270 million. Daily active users were up 36% to 50.5 million people, admittedly slightly below analyst estimates of 50.7 million, but I'm not too fussed there because I think there was a risk of this growth being far lower. But the weakness came from bookings guidance, which is a forward-looking indicator. So for example, if I pay £60 a year for a subscription to Duolingo, they can recognize that £60 in bookings immediately, but they can only recognize it as revenue as the year progresses. So £15 this quarter, £15 the next, and so on. That makes bookings a forward indicator for revenue, and management actually reduced their bookings guidance, expecting growth and now in the low 20% for Q4. That's because they're deliberately re-optimizing the entire product to focus on faster daily active user growth rather than near-term conversion from free to paid users. And that's something, the conversion side, that they've been focusing on for a while. In other words, they want to be able to teach better first by improving the product and then hopefully growing the number of people using it, and then that's a much bigger base that they can eventually monetize. I'm pretty sure this is what upset the market and made the stock fall heavily on the back of these results. Now, if this is a legitimate reason and not just, the management team trying to get investors to look the other way, then it's one I do support. If management believe the addressable audience to be in the billions, which they do and they said as much, then sure, try and get as many of those people on your platform. We can check, if they're doing this in a very easy way. Over the coming quarters, if daily active user growth doesn't accelerate or at least remains strong, then the thesis and the trust in management weakens. It's also worth pointing out that management said Duolingo is seeing no impact from the likes of ChatGPT and Google's Gemini, which is, that's kind of what I expected. Overall, whilst I'm not rushing to add to this position, I could be very tempted to if the stock is below or around $200 a share when I get to next month's investments. Next up is MercadoLibre, one of my largest holdings and easily one of my highest conviction investments. Once again, it posted fantastic numbers with revenue up 39% to $7.4 billion. The only blemish on this report was a fall in profitability. But like with Axon, that's because MercadoLibre is making the choice to invest back in itself. This time by reducing the free shipping threshold in Brazil, reducing merchant fees, and investing into their loan business. The company's often been referred to lazily, by me as well, as the Amazon of South America, but these moves are particularly Amazon-esque, ignoring short-term optics or profitability expectations in order to focus on long-term value creation. The stock dipped on the headline figure, but ended the day up, although sadly, it is still down for the month. Next up, we have the Trade Desk, whose shares have had a torrid 2025, and its latest results didn't do much to help the stock, with shares down almost 20% in the month. But I think the market is missing a trick here, because this latest quarter from the Trade Desk, I think looks far better than the headlines suggest, in my view. They achieved 18% revenue growth this quarter, coming in comfortably ahead of analyst estimates for 14.5% growth. Yeah, I think the Trade Desk's way of giving guidance continues to be misunderstood. The Trade Desk always guides to an at least number. So last quarter it said that it would, grow revenue by at least 14%, but that turned into 18% actual growth this quarter. And that's 22% revenue growth if you strip out last year's boost for political ad spend in order to make it an apples to apples comparison. I think we're seeing the same story for Q4. Analysts expected 12% growth. The Trade Desk guided for at least 13% growth, but excluding the impact of political spending, this guidance would have been at least 18.5% revenue growth. And history says they will likely exceed that. In terms of competition, co-founder and CEO Jeff Green reiterated that Amazon's ad business is overwhelmingly focused on placing adverts on its own property, namely sponsored listings on its e-commerce website, so companies can boost their products and how far up the list they end up when they search for it on Amazon, and also Amazon Prime Video adverts. So that is not where the Trade Desk operates. The Trade Desk operates in the open internet, not the walled gardens like Amazon and Google and Facebook, where the advertising platform also owns the properties that people are going to be, that companies are going to be advertising on. Sure, Amazon could cause headaches for the trade desk. But despite all the noise this year, there's really little evidence of that happening. The headline guidance does tend to make it look like the trade desk is under pressure, but look under the hood and you'll see that the business is actually chugging along just fine. So I'm very optimistic for 2026. My only personal issue is position sizing. I bought the dip quite aggressively when shares were in the 50s earlier in the year, so I've had to resist the urge to add any more and make it too large a position in my portfolio, especially because there are still risks around. But overall, I think investors should be happy with this quarter, even if shares fell by 6 or 7% afterwards. I think that wraps up the earnings reviews for this month. Sadly, at the time of recording, it's been one of those weeks where any perceived weakness in any of these high-flying stocks has been punished. And I know that it's just part and parcel of, growth investing, but it never feels fun. A couple of smaller investments in my portfolio, like Pinterest and Celsius, also saw their stock hit following earnings that the market wasn't too fond of. So yeah, bad time to be reporting results. Anyway, let's take a quick look at what I invested in when I got paid in my Trading 212 Stocks and Shares ISA. Now, the reason I use Trading 212 for my Stocks and Shares ISA, and have done ever since I started investing over 5 years ago, is because of their super low fees. This makes it extremely cost effective for long-term investors like me, and it means that I get to keep more of my returns. And Trading 212 are sponsoring this portion of the video. In fact, you can use our promo code SNS bonus to get free fractional shares worth up to £100 when you sign up and deposit £1. So this month, I decided to add £100 to MercadoLibre because it's just been a fantastic performer for the years that I've invested in it, and it's still at a valuation that I believe looks far too cheap for the quality and growth that investors are getting. I added £200 to Uber, one of the newer investments in my Stocks and Shares ISA, and I once again added £200 to my investment in Games Workshop. But I'd say the most interesting investment this month was adding £500 to Cloudflare, a brand new, albeit super expensive stock that I've decided to add to my portfolio. Cloudflare is basically a business that makes the internet run. It runs a giant global network of servers that store things like web pages on them. So when I want to load a certain website, it's not going to be coming from halfway across the world. Rather, it will be delivered to my phone or my computer from whatever Cloudflare server is closest to me. And that helps websites run much faster and stay responsive during traffic surges. This same network also works to filter out bad actors, and specifically things like DDoS attacks, which is where hackers basically try and overload a website with loads of requests, and that kind of crashes it and takes it down. And Cloudflare helps to prevent this from happening. But what's impressive to me is the company's dedication to consistently innovating and bringing new products to the market. And in particular, its new developer platform means developers can run code on Cloudflare's network itself, closer to the end users, rather than in one big data center. It's also founder-led, growing rapidly, and does have a huge opportunity ahead. But unfortunately, some stocks are just kind of permanently expensive, and Cloudflare tends to fall into this category. I do believe this company could be something special, but I am going to add it to my portfolio incrementally in the coming months. So to recap, in my Stocks and Shares ISA this month, I added £500 to Cloudflare, £200 to Games Workshop, £200 to Uber, and £150 to MercadoLibre. And in my pension, it was the standard £1,500 addition to my global index fund. Now, as I said at the start, this is our final YouTube video, but it would be great to have you join us on the Stocks and Savings podcast, where we'll keep doing exactly this, sharing our investments every single month, and honestly in a lot more detail. I just want to say thank you so much for watching and supporting our channel this year. And who knows, maybe we'll be back someday. But until then, goodbye.